Hello learners, welcome to the lesson. We are studying Introduction to Risk and Return. And as I said in our last lesson, this is a topic that was introduced for the first time in the financial management syllabus in the year 2018. So we continue with our discussion on the topic Introduction to Risk and Return. Introduction to Risk and Return. In our last lesson, we defined the term risk. And we say that risk may be defined as the possibility or chance or probability that the expected return on investment may vary from the actual return. And we went further and discussed the various components of risk. And we say that risk can generally be categorized into two. That is the systematic risk and the unsystematic risk. We gave examples of systematic risk and examples of unsystematic risk. Examples under systematic risk include the market risk. Number two, the interest rate risk. And number three, the purchasing power risk, which is occasioned by inflation. Under the unsystematic risk, we mentioned the business risk as an example of unsystematic risk, and we also discussed the financial risks. That's what we covered under our first lesson. We gave the meaning of the term probability. We gave the meaning of the term risk, and we say that risk is the chance that the expected return on investment may vary from the actual return. So risk is measured by the variability in returns. Today, we want to proceed with our discussion on the same topic, and we want to answer the question, why do we invest? Because remember, here we are talking of expected return on investment. Why do we invest? What is the meaning of investment? Those questions we are going to answer. Why do we invest, and what is the meaning of the term investment? Why do we invest? Now, when I talk of we here, I'm referring to one, individual investors. Investors can be categorized into two: individual investors and institutional investors. Institutional investors. Individual investors are like you and me, and individual investors are the majority. These are people who generally do not have sufficient skills and knowledge required in analyzing investments. Institutional investors, on the other hand, are institutions such as banking institutions, such as insurance companies, such as mutual funds. We may also talk of investment banks, and so on. These are institutions that hire professionals that assist in the process of assessing risk, analyzing securities, and evaluating performance of the securities. So when I say, why do we invest? I'm referring to individual investors and institutional investors. So going back to now the question, why do we invest? Why do we invest? The purpose for investing is to either achieve or earn some income on the money invested, to achieve some income on the money invested, or some growth, achieve some growth in the value of the money invested, to achieve some income, generate revenue streams on frequent streams of money, achieving income, or to achieve growth in the value of the money invested. And I'll be explaining that briefly. I'll be expounding on that. I want to answer this other question: what is the meaning of investment? Now, investment may be defined as deployment. Is the deployment of funds, made with the purpose, or the expectation, made with the expectation of generating returns or return. Investment is the deployment of funds made with the expectation of return on funds, expectation of returns of funds invested. We invest so that, or on expectation that we will get a return on our investment. For example, when you buy a security like shares, for example, you can say purchase of an ordinary share or stock. When you purchase a share of a company, the purpose of purchasing a share is, number one, to achieve some income, and the income on a stock is known as a dividend. The reason why an investor may buy shares is so that he may be paid dividends. Correct? Then, over and above the payment of dividends on periodic basis, an investor may want or may buy a share with anticipation that the value of the stock will increase. The value of the stock will increase. For example, if this share is bought at 1,000 shillings per share, when investing in such an asset, the investor would wish to be paid dividends, number one, or to have this value increase by a certain percentage. So that is increase in value, or both. So here we are talking of two reasons why an investor may buy financial assets. Number one is to generate income. Number two is the increase in the value of the money invested. Value invested, because an investor may buy a share at 1,000 shillings, expecting to sell this share at, say, 1,500, 1,500 shillings. So these are the main reasons why an investor may purchase stock. It may be a bond. It can be any other financial asset. So why do we invest? We invest so that we may have return on investment, income on periodic basis, or investment may be made so that the value of that investment may increase after a certain period of time. So, and I've defined the meaning of investment as deployment of funds made with expectation of generating returns, So I'll go ahead and give the different types of investment. Investment may be either economic investment, or two, financial investment. So there are two types of investment. Number one, the economic investment. Number two, the financial investment. So what is the meaning of economic investment? Economic investment is where or when a person invests in physical assets like buildings, machinery, plant, and so on, where or when a person invests his funds for the acquisition of some physical assets. And such types of investments are called economic investment. When you buy a building, when you buy land, when you buy plant, when you buy machinery, that investment is what we are referring to as economic investment. It can be defined as the investment that contributes to the net additions to the capital stock, contributes to addition of the capital stock or capital goods, capital stock or capital goods, capital stock or capital goods. So what are these capital goods or capital stock? Now, capital stock refers to the goods and services that are used in the production of other goods and services that are used in the production of other goods or services. If you have machinery, machinery is used to produce other goods, because machines may be used to convert raw materials into finished products. Plants may be used to convert raw materials into finished products. So economic investment is investment in capital goods. Capital goods refers to those goods that are used in the production of other goods or services. In short, it can be said that economic investments help create physical assets directly. Physical assets. Sometimes these physical assets are referred to as real assets. Real assets. And financial investment, on the other hand, refers to the investments of funds for the acquisition of financial assets like the shares, financial assets like debentures, financial assets like bonds, financial assets like derivatives, and so on. So these financial assets may also include things like insurance, assets like insurance policies, mutual funds, and so on. Mutual funds and so on. So they are known as financial investments. So financial investments can help in creating physical assets. When you buy shares in a company, the investor is contributing to the acquisition of the economic assets, but indirectly. When you buy debentures in a company, you will be contributing to the acquisition of physical assets or real assets in a company, but indirectly. So financial investments are the financial assets, which include the shares, debentures, bonds, insurance policies, mutual funds, derivatives, and so on. So these economic investments and the financial investments, you can see are somehow interrelated. They are somehow interrelated, and increase in financial investments. When there is an increase in financial investments, that will ultimately lead to increase in economic investment. So because the purpose of raising shares, of issuing shares, the purpose of issuing bonds, the purpose of issuing these insurance policies is so that the borrowers, the debtors, will be able to use the funds raised on shares, debentures, and so on to buy the physical assets that will help in the production of other assets or other goods and services, other goods and services. So these are generally categories of investment. So the purpose, I'm repeating, of investing, the purpose of investing either in the real assets or in the financial assets is so that the investor can have return on investment, return on investment. But you need also to see the connection between return and risk, because remember, we say that risk is a possibility that the expected return may vary from the actual return. Because the expected return when you buy a share, when you buy a bond, this return is expected to be received in future. This return is expected to be received in future. That's why we are calling it expected. And as you all know, the future is uncertain. The future may not be known. You may not be sure that the expected return will equal the actual return. What you receive in future will be the actual return that is realized. The actual return may differ, may vary from the expected return. Why? Because the future is uncertain. The future is uncertain. Now, since the future is uncertain, then there is possibility that the expected return will also be uncertain. Uncertain meaning there is a possibility that the expected return will vary from the actual return. The actual return may not be the same as the expected return. There may be variation. And this variation in the expected return is what we are referring to as risk. This is what we are calling risk. Risk is a possibility or probability that the expected return on investment may vary from the actual return. This is the meaning of risk. So these two concepts, risk and return, risk and, or we can say the two concepts, the return, these two concepts, the expected return and the risk that is associated with the return. The expected return and the risk that is associated with that return. Those two things, you are saying they are very important. They are the two factors associated with any investment. So I'm repeating, if you are making any investment, that investment you do with the anticipation of getting returns, expected returns. These returns are futuristic, and due to the fact that they are futuristic, the future is always uncertain. And if the future is uncertain, then it means that the expected returns will also be uncertain, thereby leading to the possibility or probability that what you expect not be exactly what you will receive. May not be exactly what you receive, whether you are investing in economic assets or you're investing in financial assets, which you've mentioned here, whether you are buying the physical assets, like motor vehicles, like buildings, there are always risks. Like buildings fall under the asset class of real estate. Investment in real estate comes with risk. There are returns, but there are also risks. When you are investing in other assets like motor vehicles, there are risks associated with investment in motor vehicles. There are returns, but there are also risks. If you are investing in shares, there are risks associated with investment in shares. There could be market risks and so on. Bonds also attract risks like the interest rate risks and so on. So all these investments, we have the associated returns and risks. So that is, I hope, clear up to that point. At least you now appreciate the meaning of risk. From financial perspective, risk, I said, has a special meaning. You've not also appreciated the meaning of return. What is a return? A return is what investors expect as a result of investing their funds in economic assets and the financial assets. Today we have also seen why do we invest? Why do we invest? Because remember again, if you have surplus money, surplus funds, how do surplus funds arise? Surplus funds arise when your income, when there is income, when your expenditure is less than your income. For example, if you're an accountant, your monthly salary is 500,000. Your monthly expenditure is 200,000. Then you'll have 200,000 shillings. Then you'll have surplus funds, excess funds. It is these funds that you have an option of investing, because when money is held, when you hold money without investing, this money cannot grow. For you to grow these surplus funds, you need to invest. You need to invest so as to grow the money. So it is these surplus funds that individual investors or institutional investors decide to deploy with the expectation of generating returns. But these returns, we said, there may be no guarantee that there shall be returns. Is there any guarantee that all money that is invested can be generate returns? No, there is no guarantee. You may get returns, or you may lose all your investment, depending on the risk associated with that investment. So that marks the end of our second lesson under our class of risk and returns. Thank you. I hope to meet you in our next lesson.
Thank you for watching this video. Don't forget to get yourself a copy of our professionally prepared study text and revision partners. Visit our shop along Tom Boyer Street, Pioneer House, 3rd floor, opposite Fire Station.